Hi and welcome to the week ahead with LCG. Now joining me again this week is LCG Analyst Ipek Ozkardeksaya. Ipek, let's have a quick recap on this week with all the central bank meetings that have taken place. What's your thoughts?
Well, actually, we have seen that all central banks are now playing on the loose side of the game. We heard Norges Bank cutting rates. The week before we had New Zealand lowering, ECB did the same thing. So basically the BOJ remained sitting on its hands but announced that more could be done and that the BOJ could go as negative as minus 0.5%. Following that, so we can see this chocolate cake like expanding, if we can talk about the monetary environment, and then the Fed has just been the cherry on top, as it said that it is now going to, it is the forecast of 2 rate hikes ahead rather than 4 anticipated before this meeting. So now it's all clear for everyone, I guess. The monetary environment is going to remain loose and there will be plenty of cheap liquidity in the market. So just, let's celebrate. So that was the basic scenario. So the enthusiasm after this, the Fed meeting has been short-lived, but it doesn't matter. We have seen the Dow index is recovering all losses since the beginning of the year. The SP 500 went about like the resistance levels, and so now we are looking at new highs. So it looks like the market has been reluctant, but still bad news have been good news again.
Well, now we've got all the central bank rate decisions out the way, we can now focus on the data. So looking at next week, what's in focus for you?
So actually, here in the UK, we will have the CPI figures. The market expects a 0.4% improvement on month in consumer prices versus a minus 0.8% we've seen over the last month. And the core CPI is expected to be steady at 1.2%. So now we had something important this week, is that the oil prices recovered above $40. And this means that oil producers said that they will be meeting on April 17th in Doha, whether or not Iran participates in this gathering or not. So this means that there might be some hope building that these oil producers may cut production and the oil prices could recover further to $50 level. If that happens, it will have a positive impact on inflation and inflation expectations. So at that point, we might start seeing some improvement in this consumer prices index. But for now, I believe that 0.4% is quite balanced and it's not going to trigger anything in the market, knowing that the market is mostly pricing in the Brexit risks right now, and that might be the case until June 23rd. When I digged into the nuts of the options market this week, we could see that the investors are increasingly hedging against the risk of depreciation in pound just at the wake of this Brexit referendum. So the upsides are expected to be a bit shaky. We have already seen the cable going like hitting its head against 145. Above that we've got 146.60, I guess, was 200-day moving average. But any level, any level above 145 right now is going to be seen as maybe good opportunity for those who are playing for this rise in Brexit risks.
Okay, staying on UK for a moment, we've also got retail sales on Thursday. Is that one to watch?
Well, actually, that might be some bad news because the consensus is minus 0.9% versus plus 2.3% recently. So the retail sales may have dragged down. That's nothing new. We know that the economy is slowing down, and we heard Osborne saying in his budget talk in March, like this Wednesday, that the growth forecasts have been revised down to 2% from 2.4%. So we know that the retail sale, the economy is not flourishing at the moment, and we may see some weakness in retail sales. If it doesn't go well below the expectations, I think that the market reaction is going to stay balanced.
Okay, we've got a lot of manufacturing data and also services PMI as well out next week. That's from some of the major economies. What's going to be the major one to look at here? Because obviously we've got some coming out of the Euro area. We've also got the UK as well and US. What's going to be the major one to watch?
So I think that all of them are going to be major. It's going to be the March preliminary figures. So there will be this some we have to be knowledgeable that there might be some revision by the end of this month. So the US is going to be important. In the UK, maybe the services is generally more important because the major part of the economy is made up of services sector. So the manufacturing has a little impact on the GDP figure. So it's more secondary maybe. In the US, services is expected to have stepped above 50, meaning that we were in a contraction zone, so we could now, switch back to an expansion. So that could be good news for the US economy also. But once again, we know that the economic conditions are hard right now. So any good figures or any hints of a better performance is going to be enough for, especially in the US or indices, to make a push on the upside, just because the monetary conditions are loose and there might be some signs of improvement that the investors are looking at before jumping, both feet in the market.
Okay. If we look towards the end of the week, I know we have a bank holiday coming up at the end of next week, so it's quite quiet in terms of Friday, but we do have US GDP. 1% is expected, is that correct?
It's 1% expected, and it was 1% last figure. So I think it is balanced. At the end of the day, 1% is all. Of course, it is not enough because we are used to see more than that. And at the beginning of the year, last year, the hopes that the recovery would be on by now. So 1% is not an excellent number, but it is expected and it is allowed. So if you don't see any deterioration in this number, I think that the investors would be okay with a 1% GDP number. And once again, now that the Fed has decided to keep its policy loose, we know that the economy is not doing great, but we also know that with some little bit of help, things could get better. So I think that the enthusiasm could be there, and the investors could be very well convinced to get back into the equity markets in order to push these indices a little bit higher, maybe over the next week.
Okay, just a really quick one before we wrap up. You spoke about, gave a technical outlook on pound dollar. Is there any other pairs that are looking interesting in terms of technical levels next week?
Well, I think that the Australian dollar is the one that I would like to follow up with. So we are now expanding gains about 75 cents. And as suspected, we started hearing some officials, so RBA officials, started voicing their concerns about the Aussie appreciation. So at this point, the next level is 176.80 was today's high, 177, and when we move to 178 levels, the macro funds will be keen enough to build their short positions in order to bet for a mid-term setback in this currency, just because we know that the RBA is not going to be comfortable with these levels at some point, and they have room to ease their policy more. So some verbal intervention could be very harmful. While we are just going, at this about 175, now we are just like moving towards 0.77, 0.78 levels. So this is one thing. And the other one interesting could be gold. The gold couldn't make it above $13.85 this week. So now we have seen it back to $12.50 right now. So one thing is the US dollar has started softening. So that could help the gold keeping the base at about $12.25, $12.20 levels. And, we could remain in this range of 12.20, 12.25 on the upside, 12.80, 85 levels before 1300 levels. So if we have a breakout, actually, we may see some gold recovery further, just because the Fed is expected to keep the rates low, and the opportunity cost of holding gold is minimized in this low rate environment.
Okay, Ipek, thank you ever so much for joining me. That's Ipek Ozkardeksaya there with the week ahead. Now, thanks again for joining us. See you next week. Goodbye for now.